Silicon Valley Bank, SVB, failed on March 10, 2023, making it the biggest lender to collapse since the global financial crisis of 2007 to 2009. Most of SVB's depositors were Bay Area tech startups with accounts holding well in excess of the $250,000 insured by the federal government. By betting on interest rates staying low and loading up on long-term bonds, SVB had taken an enormous unhedged risk. That bet went wrong, leaving the bank insolvent. However, what followed next revealed the flaws in America's banking architecture. Although SVB probably had enough assets for depositors to have gotten all or almost all of their money back, it would have taken a long wait, which left many tech firms facing life in a financial deep freeze. On March 12, 2023, America's regulators and government judged SVB too big to fail and guaranteed all the bank's deposits. If the sale of its assets does not cover the costs of the depositor bailout, a fund that is financed by all banks will have to chip in, penalizing the whole industry for the recklessness of a single institution. At the same time, regulators had to contend with the threat that other banks might also face runs. On March 12, regulators also shut down Signature Bank, another mid-sized lender, the third bank to fail in a week, given that Silvergate, an institution heavily exposed to cryptocurrency, collapsed on March 8. The Fed is offering generous support to shore up other banks, with a new program standing ready to make loans secured against long-term treasuries and mortgage-backed securities like those on which SVB had gorged. Usually, a central bank making loans would impose a haircut on the market value of the securities being offered as collateral. By contrast, the Fed will offer loans up to the face value of the securities, which, for long-term bonds, can be more than 50% above the market value. The deposit guarantee was inevitable, given SVB's size, and in any case, may be fully covered by SVB's assets. However, the same cannot be said for the generosity of the system-wide liquidity support, which is a dramatic expansion of the Fed's toolkit. Although the Fed's backstopping of the system will probably avert a banking meltdown, policymakers should never have gotten to a point where such extraordinary interventions were needed. After the financial crisis, America's Dodd-Frank Act required banks with more than $50 billion in assets to follow a panoply of new rules, including that they plan for their own orderly resolution if they fail. However, Congress and bank regulators watered down both the resolution planning and liquidity rules in 2018 and 2019, particularly for banks with $100 billion-$250 billion of assets, many of which had lobbied for lighter regulation. There have never been bail-in plans for banks of SVB's size. Instead, the bank briefly sought last week to recapitalize itself via a doomed issuance of new shares.